All right, I see some more people joining here. We'll get started. It's about 8 p.m. Eastern, 5 p.m. Pacific. So thanks again for joining us tonight. We're very happy to have everybody here this evening. Just before we start, I'm going to read real quick our disclosure, which is the information contained herein is intended to be used for educational purposes only and is not exhaustive. Diversification and or any strategy that may be discussed does not guarantee against investment losses, but are intended to help manage risk and return. If applicable, historical discussions and or opinions are not predictive of future events, and the content is presented in good faith and has been drawn from sources believed to be reliable. The content is not intended to be legal, tax, or financial advice. Please consult a legal, tax, or financial professional for information specific to your individual situation. Having said that, I also wanted to offer we have copies of our privacy policy and our Form ADV Part 2 on our website if you'd like to review those. But taking that out of the way, the fun part, we can start with our webinar, which is titled The 2024 Market Outlook. We have Dr. Brad Klons, Bora Bakan, and Nicholas Morata. Brad will start with the financial psychology aspect of the webinar and goal setting. So I'll turn it over to Brad to start with his section.
Thank you, Federico. I'm excited to share with you some information on the psychology of goal setting. In the spirit, we figured it's January. You've probably already achieved all of your New Year's resolutions, but it's a great time to talk about why goals are important and hopefully perhaps even introducing some categories of goals that you may not have thought about before, as well as reviewing the research on why this really does matter. So, why do goals matter? Well, a bunch of studies done on goal setting, and the bottom line is that if you can set specific and challenging goals, it motivates you. What are we doing in life if we don't have an agenda or something that we're looking forward to in the future? Interestingly, a lot of our clients are fairly good with this naturally because it goes against human wiring to even save money for the future. We have this entire psychology that has been built around our time in small hunter-gatherer groups fighting for daily survival. The whole concept of a future orientation goes against our natural brain's hardwired way of being and way of surviving for 99% of our time on this planet. And that's why I think we chronically see the average American in terrible financial shape. Now, what's fascinating about it is the average American's in terrible financial shape when times are fabulous and when times aren't so good. Interestingly, when our biggest savings rate, well, for our worst savings rate since the Great Depression happened right at the peak of just before the 2009 crash. Our savings rate was a negative 0.5%, which is really interesting. And that's when everyone was doing fabulous. And the highest savings rate we've had in recent history was in the midst of COVID, in the first few months of COVID, when people really freaked out. But the bottom line is, again, that sort of talks about that emotional brain and the amygdala, which drives all of our financial behaviors. You really have to have a future orientation in order to achieve mastery in any area of your life, because it's going to require dedication, time, and effort right now for that future goal. So it motivates us. And it also leads to higher performance compared to situations in which we aren't clear around our goals. So I want to share with you 12 key components of goal setting, and then go through a list of possible areas to consider setting goals either now, or you could save this for next year if you're done with your goal setting for the year. First, goals should be specific. The more specific the goal is, the more likely you are to achieve it. So rather than saying, I want to retire someday, it's much better to set a date at which you want to retire, and then a specific target amount in terms of like a nest egg that you want to have when you hit that retirement. So it's much better to say, I want to retire in 2030 with X amount of money in my investments. Regular feedback towards goals is very, very important. So reviewing your progress, it'll help motivate you. It will help you adjust your strategies. It'll keep your behaviors on track with that regular feedback. And we'll talk about some ways in which you can do that. Participation in goal setting can also be very important. So if you can involve others, so there's nothing better than having a supportive spouse or family member or business partner that you're collaborating with on what are these goals. It'll help you keep motivated. And it's a great thing to involve your kids in too, to help show them the value of goal setting and teach them some of the important values you might have around money management or whatever it is you're trying to teach your kids. Commitment. If you can talk about those goals, one of the benefits of having that other participation is it increases your commitment when you talk about it with other people. It helps you stay accountable. It also helps to be very specific around your goals. Have some short-term goals. Really, really important, because that short-term goal in the next year, the next 2 years, it gives you that immediate feedback. It helps enhance your motivation. And then having some of those long-term goals really do teach you perseverance and the value of that sustained effort for those longer-term goals. I think it's important to have both. It's not. I don't think it's psychologically as healthy as you can be if all your goals are 20, 30 years out. It helps to have some that are intermediate goals, short-term goals. Clarity really helps. The more ambiguous you are, the less likely you are to reach your goals, and you're going to just have worse performance. Goal difficulty. Now, this is really fascinating. A study I just read in preparing for this looked at goal setting in organizations, and we'd like to set these really, really big goals. The challenge is, and what they have found is, when they set these huge individual performance goals in large organizations, you're going to end up with like 90% of the people not hitting those target goals. So on the one hand, it sounds really great to have these huge goals. What they've done in those studies is it leads to people feeling a sense of failure, depressive symptoms, less motivation in the future, and worse overall outcomes, which was a surprising study, but it kind of makes sense if you think about it. So have goals that challenge you, but they are reasonably attainable. Self-efficacy is a very important part of goal setting. It's a very important part of change in general. You have to have a sense of confidence. You have to believe in your ability to achieve this goal. And that helps you with that persistence and that increased effort. It also is really important to set goals that really resonate with you on a deep level with what really motivates you. So materialistic goals are fine, by the way. I mean, like, we have material things we want in the world. We perhaps want a new car someday, or a motor home, or a vacation home, whatever it is. But studies also show that the more focused we are on material items, the more depressed we get and the less life satisfaction we have. So it's finding that balance. And one of the ways to do that is to really get in touch with your values. So it's not just that I want a vacation home, it's connecting that with your values. Like, why is that important to you? Is it offer you more time with your family? Does it offer you a place to relax and rejuvenate and restore? Is that an important thing to you? Does it help you really manifest that desire to have an adventurous component to your life? How can you tie those goals to those intrinsic values? Very, very important. Another great thing about goal setting is setbacks. You're going to have some setbacks along the way. And the best mindset for setbacks is, how can I learn from this and how can I grow from that? Resilience is very, very important for those long-term goals, because life will happen and things will be interrupted on the way. Visualization, so important. If there's one thing you take from this conversation, it's this, number 11. I probably should have made it number 1. But it's visualizing not just success, but your goals. So getting really specific, what is it? Make them non-ambiguous, but actually spend some time visualizing exactly what it looks like. When we did this in a study, we saw people increase, after 1 hour of visualization and drawing pictures of their goals, and these were retirement-related goals, we saw people increase their savings rates by 73% on average across the board, just by having a clear vision, because it got them very excited and very motivated and very willing to do what it takes in the here and now to sacrifice and delay gratification for this very exciting goal. But you have to be able to see it. You have to be able to picture it. It helps connect your emotions to it. And that's really what drives our behaviors, is that emotional connection. And lastly, number 12, focus on the process, not just the outcome. And this is, again, based on some recent research on goal setting. We like to have a goal of, for example, that vacation home, the outcome of what it is we're wanting. As an example, you got to focus on the process too. So what is the process by which you are going to achieve that goal? Is it increasing your income? If so, how are you going to do that? Is it setting aside a percentage of your income? How are you going to do that? Is it something that's going to require a one-time behavior where you're automating it? Or is it something that's going to require an ongoing behavior every quarter, every month. You're looking to find ways to increase that income. It's really a focus on the process. You have to have the goal. You have to know what it is. You got to get really specific. You got to connect it with your values. And then you need to shift your focus to the process. So for example, you want to lose weight. You might have that target pound amount you want to be. And that's great, but you really need to focus on the process. So are you going to, for example, weigh yourself every day? Or what is it you're going to be doing? Are you going to use that app Noom, by the way, which is a real good one to use? It brings all this psychology into it. What is the process by which you're going to achieve those goals? Very, very important. It will help increase your commitment to the goal, decreases your anxiety, and it'll help you reach your goal much more successfully. So those are the 12 key components. We'll give you the slide deck if you want it. But I want to introduce at least some areas that perhaps you may not have thought about that people can set goals in. And what I like to do each year, and actually my wife and I sit down and do this, and we go through all these categories. We usually do it on New Year's Eve. What are our goals for the year? So there's a bunch of categories here. So you can think about if there's any areas here in which you want to make improvements or make progress. So of course, career goals. Is it developing new skills, starting a new profession? Educational goals? Are you looking to complete a degree, to learn a new skill set? Is it financial goals? You want to save more money for a particular milestone, increasing your retirement savings? Health and fitness goals. Do you want to work out more? Do you want to eat better? If so, how many times a week? How are you going to do it? Relationship goals. So if you want to have a better relationship with the people you love, what are you going to do about it? Are you going to set aside regular dates? How many days a week are you going to do that? Are you going to make more frequent calls to your friends and family? Personal development goals, developing new skills or hobbies. You're going to enhance your self-confidence. You're going to read some self-help books. Travel and adventure goals. Do you have a bucket list of places you want to go, of things you want to do to really help engage in that adventurous part of you? Creativity and hobby goals. Are you looking to pursue some artistic endeavors? Are you setting goals for some type of creative project? And community and social goals, of course. So how do you want to impact your community in a positive way? Is it volunteering? Is it charitable giving, which we'll be talking about soon? Or is it spiritual goals? Are you looking to deepen your connection to your spiritual beliefs, to attend more spiritual or religious events? Do you want to meditate more? What is it you want to do? So I'd encourage you to review this. Perhaps you can pull it out next year if you already have your goals for this year. I think goal setting is something that's very, very important. And actually, you probably, if you're a client of our firm, you probably wouldn't be a client of our firm if you weren't good at some level in terms of setting goals. But it's something that I think I teach my kids this stuff, and I encourage them to have goals. And so we sit down and we go, what are your goals? I got a 10-year-old and a 6-year-old, and they have goals. They have goals. They have very specific goals for 2024. So I'd encourage you to utilize some of this as you're thinking about how can I set goals, or how can I mentor other people who want to set goals, perhaps employees, children, grandchildren, et cetera. So with that, I'm going to kick it over to a discussion on charitable giving strategies to optimize your tax savings.
Thanks, Brad. Great information there. Hello, everyone. I'm Nick Murata. I'm a partner at the firm here and a CFP. And tonight I want to talk about the charitable giving strategies to optimize tax savings. And I should just preface this by saying I'm not necessarily advocating charitable giving, but if you do have a charitable giving goal or inclined to give to charity, what my focus is tonight is how we can do that in a way that optimizes another benefit, which is paying less taxes. And there's really two strategies that we're going to be looking at. And this just kind of scratches the surface, but it's a donor advised fund, also called a DAF, and a qualified charitable distribution, which is a QCD. We love little abbreviations in our industry. So to set some kind of a just level playing field, we have to understand the difference between standard and itemized deductions when doing a charitable contribution to get a tax deduction. Basically, everyone gets a standard deduction, and depending whether your standard deduction or your itemized deduction is higher, you take the higher of the two. And itemized deduction are things like property taxes up to a certain limit, and mortgage interest, and charitable giving. So you add all these itemized deductions up, and if you come up to this level, but your standard deduction is higher, you actually take the standard deduction. So even though in this lower amount, the itemized deduction includes a charitable contribution, you don't actually get any kind of additional tax deduction if you are taking the standard deduction. So it doesn't really count from a tax benefit perspective. And that's not why we necessarily give, but it's also nice to get the benefit of a tax deduction when you are giving to a charitable organization. And so the limit is pretty high right now. So the standard deduction for 2024 for joint filers is $29,200, and for individuals is $14,600. If you're over 65, you get a little boost at $32,300 for joint filers and $16,550 for individuals. So I'm going to give you an example of somebody or a couple that gives to charity, but it really isn't benefiting from the tax side of things. So we have a married couple, and they basically, with all their itemized deductions, their property taxes, their mortgage interest, their $6,000 a year, which happens to be their charitable giving goal, they get to $28,200. Well, they're just shy of $29,200. 29,200, which is $1,000 more. So basically, for giving to charity, they still take the standard deduction and they don't get any kind of additional tax benefit. So there's something called a bunching strategy that you can do to get above that standard deduction to actually take a tax benefit, where you're really giving the same amounts, but rather than giving $6,000 per year in this example, you give $18,000 in year one. Then you skip year two, you skip year three, and then you give $18,000 in year four. So essentially, you're giving the same thing as an average of $6,000 a year, but you're lumping them into 1 year and then waiting a little while and then doing another bigger contribution. By doing that, you actually get your itemized deduction in this case all the way up to $40,200 versus that $28,200. So you're actually getting a tax benefit from it. And in this case, if you're at the 35% marginal rate, you would get $3,850 in tax savings because you're getting above that standard deduction. And it's still giving the same amount of money. It just changes the timing of when you're giving that money. Another added bonus can be if you actually have assets that are have a lot of capital gains and embedded tax liability built up in them, you can actually donate directly to charity and that capital gain is removed. Now, you may notice kind of an issue with this is that, well, maybe you don't want to give $18,000 to one charity all at once or in 1 year in particular. Yes, you have a giving goal of X amount per year, but you spread that out. Maybe you give some to the church and you give some to this organization, or there's a disaster over here, whatever it may be, but you don't want to make the commitment, all in 1 year and then wait another couple years to do like a bunching strategy. So then enters a donor advised fund. So we work with Schwab, and Schwab Charitable has a donor advised fund, which is basically a charitable investment account that allows donors to make charitable contributions, but gives grants to charities over the course of time. So you don't have to, you can basically put money into a donor advised fund, and you can either do cash or property, such as capital appreciated stock. It goes into that fund as an irrevocable gift to charity at some point in time in the future. But you could give your money now, and then you can give grants to organizations over the course of time. And there's no limit on that time frame, but you get the tax deduction up front. But in the interim, while you're giving out those grants over the course of time, you can actually invest that money. And by investing that money, it can actually grow and then provide even a bigger benefit to charity over the course of time. This is one of the fastest growing charitable giving vehicles in the industry, is a donor advised fund, and it has a lot of flexibility. So going back here where it says contributes cash or property, property can be a lot of different things. Most commonly, it's capital appreciated stock, but it can be private equity interest, restricted stock, equity compensation, cryptocurrency, real estate if it's a sellable. So there's a lot of different things that you can actually donate into a donor advised fund. So just to recap there, with this, you get a current year tax deduction, you donate highly appreciated stocks, and that will minimize your capital gains. And I'll go over an example of that. You can distribute the money at a later point in time via grants. And in the interim, that money can grow over the course of time. And then you can also receive acknowledgement for your grants or give anonymously if you prefer, which is kind of nice, which means once you give to an organization, if you do it anonymously, you don't get all the mail that follows with asking for, more money, essentially. You can even acknowledge people and give in honor of other people, which is a nice thing as well. So rather than writing a check to the donor advised fund or a check to charity, here's an example of actually donating stock. So in this example, and this is from our friends at Schwab Charitable, you have $50,000, which is the fair market value of a stock. You paid $5,000. So you have $45,000 capital gains embedded. If you sold that stock and generated that capital gain at a 15% rate, you would pay $6,750 of taxes. You then would only have $43,250 to give to charity. And so your total tax savings really is only $3,630 if you can itemize all of that. The same scenario where if you give a stock to charity before you sell it, you don't pay any capital gains tax. So that's zero. And you can actually make a bigger contribution because you don't pay capital gains tax at $50,000. And so you actually get a deduction of about $12,000, and this is at a 24% marginal rate. So in just this example, versus selling it and giving it versus giving the stock, you save an additional $8,370 in taxes overall. Now, what's particularly nice about this is if a stock goes up, you probably kind of like it as well, but you can get rid of the capital gain by donating it if you have those charitable goals. And then you can just buy the stock right back. And then instead of having a basis way down here, you can change your cost basis to where the fair market value is. And if it continues to go up, you have less embedded tax liability in the future. So this is really effective of boosting kind of your tax benefits of using a donor advised fund coupled with a capital appreciated property. I'm not going to go through all this. This looks very complicated, and I don't want to take you through it. But we generally use this in the financial planning process in two ways. One, you either have an ongoing charitable giving goal, and we want to make sure we optimize that, not change it, not change how much you give, but optimize it to get actually a tax deduction. And so that's what we just talked about. Or if you have a year where there's a big tax event that happens, you sell a business, you sell a property, and all of a sudden you're going to pay this much tax, and you usually only pay this much tax. So it would make sense to think about, well, am I going to continue to give the charity at this level? And maybe I want to front load this charitable contribution into the donor advised fund and get a tax deduction on the year where I'm at a much higher marginal rate versus the next year where I'm not at that marginal rate. So we utilize that to kind of offset big tax impact years along with your charitable giving goals. The chart I'm showing you is kind of, if you have questions, you should discuss kind of what your ongoing goals are with your advisor, and we can help you out with what strategies make sense to maximize those opportunities. The second thing I'm going to talk about is a qualified charitable distribution, a QCD. And to understand the QCD, you have to understand that if you have an IRA account, right now when you turn age 73, the government will force you to take money out of your IRA account. And the older you get, the more they force you to take out as a percentage. So at age 73, it starts out about 3.5% of your value of your IRA based on the previous year, and then it goes up from there. And any money that comes out of your IRA is added to your income for the year, and you pay the appropriate taxes with it. So in the previous example, you may not have the ability to get over the itemized amount. The standard deduction for over 65 and a couple is $32,300. That's a pretty high bar to pass. And generally, there's not a lot of mortgage interest and other itemized deductions because there's paid off houses and so forth. So that's a pretty high bar. But if you actually do a qualified charitable distribution, which means the money comes directly out of your IRA account to a charity, it is not included in your income. So it's the same effect of getting a tax deduction, because otherwise you would have to take that money out. So a QCD can satisfy your required minimum distribution and doesn't add to your income. What's kind of a little nuance is the required minimum distribution age starts at 73. The qualified charitable distribution age starts at 70 and a half. This is just one of those things that the IRS does to confuse us all, I guess. But really it has to do with the RMD age used to be 70 and a half. And then when they changed the RMD age to 73, they just didn't change the QCD age. So you can actually do these at age 70 and a half versus 73. So this can be effective if you have ongoing goals. Rather than writing a check to a charity and not getting any tax benefit from it, take it off the top of your RMD and get a tax benefit from it. There is even check writing you can add to Schwab IRA accounts to kind of help you out with giving directly to charities overall. And you have to think about your IRA as well as a bucket of money that has some embedded tax liability. And the older you get, the percentage of what you have to take out gets higher. So if you have the charitable goals earlier on, you can reduce down some of that future embedded tax liability overall. So this is again just a flow chart, and we can if anyone has would like to request these, we can send them out to you. But again, if you communicate these things to us, then we can help you out with the best strategy overall to optimize the tax benefits. One questions I get a lot is, and it sounds like a perfect thing, is, oh, can I take the QCD, qualified charitable distribution, and put it in the donor advised fund? That's a no. So you can't actually put it in a donor advised fund. A QCD has to go directly to the charity. It would be nice if it could. That would even make it even a better strategy overall. But there are nuances with this, so it's good to talk with us first, and we'll help you out in regards to meeting your charitable goals in an efficient manner. So that's really all I had to talk about in regards to the charitable giving part. I will pass it over to Bora, and he will go over the tough part. I took the easy part tonight, but he'll go over the tough part, which is the market outlook.
Hi everyone, good evening. I will try to cover this year's market outlook, global market outlook. I'll start by talking about how we finished last year, how the sentiment was, specifically sentiment, crowd sentiment, meaning investor crowd, and what that means for the markets. One counterintuitive aspect of our world investments is that when there's too much optimism, it typically works as a contrarian, and we may see a pullback after. And the opposite is also true. When there's too much pessimism, we may see an uptrend. Now, look at this chart. The bottom bracket, the orange line, shows the crowd sentiment poll, and the right level here is very similar to 2021 and 2022, and the top bracket is the S&P, and you can see after high levels of optimism, we may be vulnerable, the market may be vulnerable to a pullback. So coming off of last year's extreme optimism, it wouldn't surprise us to see a pullback coming into 2024, a quarter, maybe even two. That also translates into potentially higher volatility in the market. Now, this doesn't mean we are bearish for this year. We're cautiously optimistic, and I'll argue that case. As long as you stay with your strategy, I think stocks and bonds will have a decent year this year. But with volatility and coming into these levels of capitulation, that's one word I like to throw out there, makes these stocks, especially in the first quarter, a bit vulnerable. Volatility, if you look at the top bracket and bottom bracket, if you knew nothing else, I hope you will agree that you will see an almost perfect inverse relation. When the top bracket goes up, the bottom bracket goes down. The opposite is also true. Now, this is the global stocks versus volatility index. So when I mentioned we may see a pullback, which is a healthy ebbs and flow movement in the market, It also may coincide with rising volatility. Look at this side of the chart. This is volatility. You see how low it was towards the end of last year, and we saw the uptrend in the markets, which is not surprising anyone who looks at these. Last 2 years, 2022 and 3, were very unique in many cases. I'll quickly pass this chart to the next one if this is a little difficult to explain. But last year, especially, a handful of stocks, large cap US tech stocks, carried the market on their shoulder. And what we call breadth, which is participation in the market, it was quite low last year, but it picked up towards the end, and which was a really healthy sign. So imagine breadth. Let's say there are 100 stocks, and only 20 of them go up, and that's the index you look at. You will think the market is going up, but 80 stocks would be trailing. So the more stocks participate, the healthier it is, especially, obviously, in an uptrend. Now, look at the bottom bracket again, the orange line. This is the percentage of all country world index markets above their long-term averages. When I was preparing for this webinar, this was 83%. And in fact, getting ready, I jotted notes saying it wouldn't surprise us to see a pullback from these high levels of 83%. And I checked myself, and right now, actually, it's down to 70%, but it's still a positive uptrend from low levels. You can see here in this area, all the way below 30%. Now it's up to 80%, now down to 70%. So breadth, meaning participation in global stocks, has improved, which is welcome news if you are bullish in your investing, if you don't short stocks. Now, one of our baseline assumptions for 2024 is that Fed is done with rate hikes. In fact, we may see rate cuts this year, especially in the second half. Now, when that happens, stocks typically rally, even bonds rally. So that's one of the reasons why we are cautiously optimistic. Fed is the whale in the pool. What they do, they don't do affects stocks and bonds, capital markets. And Fed rate hikes being paused will have positive effect in stocks and bonds. Now look at this chart. So this left side is when the Fed rate hikes stop. And these lines are different times in history when all country world index stocks, how they performed. Except the blue line, which is the NASDAQ period, year 2000, excuse me. In all cases, stocks did well, and we are so far from the year 2000 NASDAQ type of a bubble. The conditions are so different, not even an apples to oranges, just like apples to a chimpanzee comparison. So it wouldn't again surprise anyone to see a market rally once market prices and the end of rate hikes, and in fact, rate cuts even create a stronger rally. Now, another baseline assumption we have this year for 2024 is the low recession probability. Now, this year's GDP growth, gross domestic product for United States, net after inflation, is around 1.5%, which is not too exciting. I agree with that, but it's very different from being in a recessionary period, which coming off of the inflation rate coming down, so nominal, which is inflation rate plus the real rate, we may be looking at 4 or 5% growth in the economy, which is not again something to be too excited about, but we don't see recession as a high probability event this year. Now, the reason why I mentioned nominal growth, because it ties into this chart. So just like sentiment, in extreme cases, earnings growth, even though you may pick up your newspaper or financial news magazine, and you see the headline, oh, earnings growth really strong. I'll point to this history on earnings growth. Year-over-year earnings growth, when it's about 20%, the annual gain is 1.5% in stocks. So why is that? Because typically stocks are leading indicators, and high levels of earnings typically point out to the end of the business cycle, and it may be time, at least as far as stock valuations are concerned, time to go for safety. Now, it's currently between 5 and 20, which is actually 13%. Now, this is in the middle of the road growth in earnings, which is, again, nothing to be excited about maybe, but nothing to be concerned either. If you look at this figure, it's 6.7% year-over-year growth when earnings growth are at these levels. So this ties into our sentiment with this year's stock move, which is cautiously optimistic. We don't see a recession. We may see some volatility, but still we have positive views about stocks this year. Now, Fed stopping with interest rate hikes is not good news for dollar, because one of the reasons why dollar did well, has been doing well last couple of years, because of the interest rate differential between US dollar and other major currencies, because Fed was faster in rate hikes. The moment it became obvious that Fed was done or getting close to be done, this was priced in, and because of the diminishing differential between the interest rates, we may see weakness in dollar. It has good news for international investors. If you are a dollar investor in Europe and emerging markets, which we are, this is actually good news for investing internationally. This also could be good news if you're a gold investor. These two brackets, the top is the dollar index and the bottom is the orange line is the gold index. Again, it's not perfect, but close to perfect inverse relation between dollar and gold. So one of my clients called me and said that they were selling gold in Costco. So when something is that becomes that mainstream, I would actually go the other way. So most of the good news in gold may actually be priced in. Going back to the dollar comment, emerging market equities move with currencies. So it wouldn't again surprise us if we see some relative strength in emerging market equities because of the weakness in dollar. Let's touch on bonds. I know Nick used these terms too. They're kind of funny. Tina is there is no alternative, and Tara is there's a reasonable alternative. Over a long period of time, bonds have been giving us a heartache, let's say. Low returns, low income, no real after inflation income. So it pushed pension funds and fixed income investors and retirees to stocks. That was there's no alternative time. It's not the case anymore. The yield in 10-year treasury yield and S&P earnings yield, it's this top bracket here. It's actually now has been positive in that it's either comparable, and if you actually gauge the risk on a risk-adjusted basis, 10-year treasury yield, if you're an income investor, so much more attractive than the yield you're going to get in stocks because of the volatility in the valuation. But to make a long story short, at least this year, for fixed income investors, pension funds, and retirees, conservative investors, you'll at least have some positive returns in your bonds from the income side of things. Even mutual fund, the money market mutual funds pay 5%, so which is compared to some years back, much welcome news. Now, we would be remiss if we don't talk about election. This is an election year. It actually coincides and it's parallel with our other technical readings. So this is a 4-year presidential cycle, and I'm almost done. We'll open up for questions. I think this is my last chart. four-year presidential cycle study. So this is the year we are in. This is the first half, the yellow or orange, depending on how you see this color. We expect a choppy first half, January through May. As the elections end in November, after that, typically there's an uptrend because whoever wins, it means certainty, and certainty is the main ingredient in an uptrend. And then it ties into the following year's uptrend. But again, if you remember my first chart, I'll finish with that. Because of high levels of optimism from last year, extreme sentiment, crowd sentiment, and because it's an election year, and because stocks have been doing well in the last few months, a choppy, high volatile first or second quarter wouldn't surprise anyone. But unless we had a recession, Fed cut, or once the Fed hike and news has been priced in, I think second half of the year might be exciting for all of us. So executive summary, which is basically what I just did. We expect we're coming into a year with high optimism, a choppy first half, and high volatility. Wouldn't surprise us. Post-rate hikes, positive year, potential for both stocks and bonds. Muted earnings growth, as I mentioned, also translates to muted stock returns, but not negative. The diminishing rate differential between major currencies and central banks bodes well for international stocks because it creates weakness in dollar, and which is positive for gold. We are in an election year, so as I mentioned, it overlaps with our other technical readings, and we don't see a huge probability for recession. 1.5% GDP growth this year would be our baseline assumption. Thank you so much, Federico. It's all you.
All right, perfect. Thank you, Bora. And so now we just had a couple minutes for questions. I'm going to open right here, see if we've received any questions really quickly. I only really see one question, and it's about charitable donations. So let me read this, and I think this was appropriate for Nick, which is whether or not somebody is passionate about giving to charity. Is it a good way to save money or pay less taxes?
Well, giving to charity in a way that you can take the tax deduction will lower your taxes, but the amount you give to charity will be higher than the amount of taxes that are lowered. So if you do not have a charitable giving goal or charitably inclined, then the strategies that I talked about would not be applicable.
Okay, great. Well, I think that's really all the questions that we had. But again, if you do think of anything, maybe you're watching this replay and you have any questions, feel free to email us at info@ymwadvisors.com, or reach out to us, reach out to your advisor with any questions you have. We would love to hear from you, as well as any feedback that you have. But other than that, we hope you have a great rest of your evening, and thanks again for joining us. Take care.
Take care.